In the fast-paced world of cryptocurrencies, one term has been making headlines and sparking curiosity among enthusiasts and investors alike: halving. Make sure to stick around to the end of the video if you want to understand what this major event is and how it impacts on crypto investors. Cryptocurrency halving is an event programmed into the code of certain cryptocurrencies, such as Bitcoin, Litecoin, and others. It occurs approximately every 4 years and involves cutting in half the rewards miners receive for validating transactions on the blockchain. Imagine you're a miner, dedicating your computational power to secure the network and validate transactions. During a halving event, the rewards you receive for your efforts are slashed in half. So, if you were earning 12.5 bitcoins per block before, after the halving, you'll only receive 6.25 bitcoins. But why go through all the trouble of halving? The primary reason is to ensure the scarcity of cryptocurrency, much like precious metals such as gold. By limiting the total number of coins that will ever be in circulation, halving helps preserve the value of the currency over time. Think of it as a slow-release mechanism for new coins. As mining rewards decrease, miners are incentivized to continue supporting the network, maintaining its security and stability. Moreover, the anticipation of reduced supply often leads to increased demand, contributing to price volatility and market dynamics. In essence, halving reinforces the scarcity narrative of cryptocurrencies, emphasizing their store of value characteristics. This narrative attracts investors seeking assets with capped supplies, especially in light of inflationary pressures affecting traditional fiat currencies. Now, let's take a closer look at the concept of halving in the context of Bitcoin. It's a process where the reward given to miners for validating transactions on the Bitcoin network is cut in half. This event occurs approximately every 4 years, specifically after every 210,000 blocks are mined. Let's break it down further. When Bitcoin first came into existence, miners were rewarded with a hefty 50 Bitcoin for each block they successfully mined. But then came the halving. The inaugural event took place on November 28, 2012, reducing the reward to 25 Bitcoin per block. Subsequent halvings occurred on July 9, 2016, slashing the reward to 12.5 Bitcoin, and on May 11, 2020, further reducing it to 6.25 Bitcoin. Now, all eyes are on the next halving, expected to occur on April 19, 2024. After this event, the block reward will fall to 3.125 Bitcoin. But what exactly are the implications of this monumental event? When the Bitcoin halving occurs, the reward for mining new blocks is cut in half. This reduction in rewards directly impacts the flow of new Bitcoin into circulation, thus affecting the supply-demand dynamics of the cryptocurrency. Not only does halving reduce the rate of new coins being introduced, but it also plays a crucial role in making Bitcoin a deflationary asset. Just look at the numbers, from a staggering 50% inflation rate in 2011 to a mere 1.74% today. But here's where it gets really interesting: after each halving, the value of Bitcoin tends to surge. This phenomenon, known as a bull run, is driven by the decreasing supply and increasing demand for cryptocurrency. The price of Bitcoin would need to increase dramatically in order for miners to get half as many coins, due to the high cost of electricity required to run the computers that solve the mathematical puzzles. If the price does not increase in proportion to the decrease in reward, miners will struggle to maintain their competitiveness. A new technology that can produce more hashes per second while using less energy and cutting overheads will be needed, since miners will need to be as efficient as possible. Moreover, the price of Bitcoin may be impacted by the economies of the nations that participate. More importantly, the increased attention that Bitcoin is currently receiving is probably going to cause its price to rise. Now, let's talk about predictions regarding the increase in the price of Bitcoin. The brilliant CEO of Galaxy Digital, Michael Novogratz, is no stranger to audacious forecasts. In an in-depth interview with Forbes, he shared his opinion that, following the halving, the price of Bitcoin might rise considerably. This forecast is supported by a thorough understanding of Bitcoin's place in the emerging digital economy and is not just conjectural. Novogratz highlights how younger generations are driving a paradigm shift in economics by favoring digital assets as instruments for economic innovation and reform. With a unique twist, Marathon Digital Holdings chairman and CEO Fred Till echoes the sentiment of notable post-halving growth. Till believes that Bitcoin will hit $120,000. Furthermore, he credits Bitcoin's limited supply and its strength as a store of value for this possible rise. Till thinks that one of the main reasons why Bitcoin will increase in value over time is that it is more scarce than traditional commodities. Till also emphasizes the revolutionary effect of Bitcoin ETFs, which he claims will increase market stability and liquidity. An important turning point for Bitcoin is the introduction of exchange-traded funds, ETFs, which give investors more options for investing and increase the currency's appeal to a larger market. Let's consider another significant aspect of halving. Imagine a scenario where a substantial number of Bitcoin miners suddenly decide to call it quits. What would happen to the world's most popular cryptocurrency? First off, let's talk about the hash rate. The hash rate represents the computational power dedicated to mining Bitcoin. If a significant number of miners were to suddenly stop mining, the overall hash rate of the network would plummet. As a result, block formation times would increase, transactions would take longer to confirm, and the overall security of the network could be compromised. In fact, there's a risk of a temporary bottleneck in the network, as users scramble to find more efficient chains. This could create opportunities for fraudulent users to exploit weaknesses in the network. However, historical evidence suggests that halving events don't necessarily trigger this reaction. In fact, during the first halving in 2012, Bitcoin's hash rate dropped initially but eventually rebounded. Similarly, the second halving event saw a temporary decline in mining profitability, but the hash rate continued to rise steadily. If this pattern continues for the next halving event, we could see a prolonged decline in mining profitability. Miners may face challenges in maintaining profitability, which could have implications for the long-term sustainability of the Bitcoin network. And there you have it, folks. Bitcoin halving is demystified. Remember to hit the like and subscribe button for more informative content. Until next time, keep holding, and happy investing.